Annabel, let's touch on the private sector versus government and look at the fact you referred to a global competitiveness report in the break. Private sector coming in the top 10 from a global competitive perspective, and then government, South African government, coming in at the bottom. That's a disparity that we've got.
Yeah, the global competitiveness report is it's a survey of CEOs internationally looking at the ease of doing business in a country. And South Africa scores extremely highly, number 2 in terms of soundness of banks, number 1 in terms of regulatory environment, number 8 in terms of legal rights, basically showing that our private sector is extremely well run, ranked extremely highly globally, and obviously showing South Africa has great ease of doing business in South Africa in terms of the private sector. But in terms of government, in terms of security, of safety and security, health delivery of health services, general service delivery in general, it falls down quite substantially. And I think, given these poor rankings, it becomes even more imperative for greater private sector involvement in the delivery both of infrastructure. And of course, one of the points about privatization obviously is that the private sector then runs some of the assets. The problem is that it is problematic if it's a service that is required by the nation. It actually can't actually close down. So some institutions need to remain. Well, look, Australia went on a huge privatisation drive, and that's how they massively reduced their debt levels. But, some institutions need to remain, and otherwise we would need to see continued provision of electricity. But in terms of actually the private sector involvement, I think government's missing the boat here. Not only do we need to greatly increase the private sector, because that's the only way you're going to double GDP. Increasing government's involvement and increasing state regulations is actually not going to grow the cake in South Africa. And, that's a key area. We need to double the actual rand value of GDP.
We'd be remiss if we didn't speak about interest reductions on share acquisitions.
Yeah, Bronwyn, it's an issue that's been on the table for many years. It's been an impediment to mergers and acquisitions in the sense that you generally speaking can't get a deduction for interest that's incurred to acquire shares in South Africa, and it's great that that Treasury has now announced that yes, that they're going to allow deductions on share acquisitions in certain circumstances. Again, as I said earlier, the devil, as always, the devil is in the detail, and we'll have to wait and see what the final legislation looks like in that respect. But it's good news as a whole.
Sneaking in there, the proposed increase on the withholding tax on royalties and interest. That's a surprise. It
was a surprise. It probably, it's in line with the increase on the dividends tax itself. The surprising thing is that South Africa thinks that they're going to get anything out of it. The problem being is that those taxes are actually levied on non-residents, and South Africa gives away most of its taxing rights in relation to those two items of income to the non-resident countries in terms of double tax agreements. So for that to really add anything to the fiscus is going to take a renegotiation of double tax agreements, which is a long and tedious process if the other jurisdictions are even willing to enter into those negotiations.
Well, of course, coming back to STC being replaced finally by the dividend withholding tax, that's coming into play on the 1st of April 2012. Again, that surprise from 10% to 15%. How is the market going to react?
Again, Bronwyn, if you looked at some of the results that were actually out earlier this week, late last week, some of your retailers, they'd actually decided to hold back on the dividend until there was more clarity in terms of how this dividend tax would play out. That obviously, in light of this particular change, would obviously be in good stead. The rest of that, the market really will have been working on this 10%. Now there's a 15%. Will it impact share prices materially? I don't think at this point in time, but certainly from a financial planning perspective, it does seem to complicate certain investors' calculations, certainly, and they just have to factor this into that. Whether it makes it any less attractive or not will probably need to be seen. I don't think there'd be any real material impact at this point in time.
How do you think the market is going to react to this budget? We always say a good budget is one that doesn't shock the market. Nothing out there that's going to move the market. Do you agree?
Yeah, again, Bronwyn, the predominant themes that are actually driving the market right now are less domestic than they are global. So the market's still looking more at Greece's budget and the Eurozone situation, and that's really driving sentiment. So a bit of a non-event when you look at our local budget. There's nothing that's really game-changing in the budget, and that would really be something that I'd see continuing.
Fiscal stimulation is still the order of the day. What happens when we turn to normalization of interest rates come 2014, come 2015? Are a lot of people going to be caught with their pants down?
You know, I think the worry is that we've had very low interest rates in Africa for a long time. They're still at the recessionary 2009 levels. We need to see interest rates return to a more normal level. They need to return to a neutral level. And the worry is that in real terms, interest rates are negative in South Africa. So they're very, very stimulatory. So you're getting double stimulation to the South African economy. Clearly, consumers have become used to the easy credit environment. And the worry, obviously, is that when interest rates rise, we think about 2.5% over the 2013 to end 2014 period to bring them to a neutral level, possibly another 0.5% in 2016. That 3% rise in interest rates could actually hit quite hard. Remember, a lot of the growth in retail sales at the moment is on the back of unsecured credit. So consumers clearly have used their access bonds. They're unable to use more. So we're seeing a vast proliferation of unsecured credit, very, very strong growth rate. And if we do see the significant rise in interest rates, they could actually see a bit of a pullback. So we're moving into an environment where there's potentially going to be overcrowding in the bond market. We're going to see longer term interest rates rise. In the short end, you're going to see the normalization of interest rates. In other words, interest rate rises as they move to a more neutral level. And that combined rise in the cost of doing business in South Africa could actually translate through into a bit of a pullback. So these are some of the worries on the horizon.
You mentioned the unsecured lending. Of course, the big debate taking place. Is the bubble going to burst in that territory? Do you think it will?
Well, there's been a very definite switch. You know, the growth rates over the past year have dropped down dramatically in terms of mortgage bonds. And I think people have actually used up their access bonds. They can't access more, and they've moved now to easy credit, whether it's credit cards, whether it's microfinance loans, you know, whether it's overdrafts. All these facilities are showing incredibly rapid growth, especially to the household sector. And I think the worry is that if that's fueling our retail sales, remember 8.7% is a very heady number for retail sales growth for December. And you saw that on consumers spoiling themselves in appliances, on clothing and footwear, on the real festive spend. Then there may be a pullback later on the consumption side when we actually see this tightening taking place, especially if they bring in tax increases as well, which is not out of the question as the economy strengthens in the next few years.
Savings rate in South Africa is still sitting at around about 80%. Where is the news flow that's going to stimulate savings in South Africa? Did you see it? It missed me.
I didn't see it. Look, I mean, from a tax perspective, there were clearly some proposals that were aimed at stimulating savings. I mean, I spoke about the tax-preferred savings vehicles and so on, but there were many other proposals which were anti-savings. Things
so
like
net,
the increase in the dividends
we
tax
see
and so on.
no change in the game.
So yeah, it is a bit concerning that there doesn't seem to be any defined route that they want to follow and so on in that respect. So yeah, it's a bit concerning.
We are coming to a conclusion on our post-budget analysis. Mohammed, what would you have liked to have seen in the budget that we haven't spoken about, that you haven't noticed?
I think it's less about what we haven't spoken about and just maybe more about clarity. So, for example, savings, a very, very critical component there. How are we going to fund all of this infrastructure spend? You know, some decent, clear proposals in terms of boosting that savings rate, that would have gone a long way in enhancing the quality of what we actually get out of this budget. Again, when you start looking at households that we mentioned earlier, you know, in terms of incentivizing savings, how is that even going to play out if households are excessively indebted, if we're seeing them really drawing down on that, and this consumption culture, you know, really continuing? It might be great for the retail sales, as you mentioned, might be great for tax receipts from all of those retailers right now. But as the cycle plays through, as we start seeing, you know, your administered prices, we saw those fuel levies really kicking up, that's going to start coming through, biting the consumer. We're going to see this interest rate cycle, you know, potentially normalize. All of this is going to come through, and the implications for growth going forward might actually make it quite difficult to meet some of these growth projections if the global scenario doesn't necessarily pan out as positively as we're really kind of factoring into this. So maybe a little bit more detail in terms of taking it just the next step further would have enhanced this budget significantly for me. We
haven't spoken about the toll roads and that cap of 550 Rand per month. Anyone want to take this quickly before we come to a conclusion? Are you happy with that, Annabel? Will you pay 550 Rand a month?
Well, I'm probably not going to be one of the ones that are paying the e-tolls, unfortunately, for the majority of, you know, South Africans. I mean, the reality is I live quite close to work, and you know, I'm not going to be on the road every single day, but I think for sales,
do you think there's still going to be an outcry there?
Well, definitely. You know, it all falls into the ambit of administered price. This is the point I wanted to make. What I would have liked to see in the budget is significant focus both on the escalation of administered price. We cannot have electricity prices rising by 25% every single year. That is not sustainable for economic growth in the South African economy. The real worry is that we're in a situation now where indeed inflation is actually being undercounted by up to 2% in South Africa. 6.3% maybe the prevailing CPI inflation rate at the moment, as far as Stats SA calculated. The worry is that if you actually bring in a 25% every single year, the weighting of electricity is far too small. We should actually have a significantly higher inflation rate. These are factors that National Treasury should have addressed, given that they are actually in control of setting both the inflation target range and indeed overseeing Stats SA in the calculation.
So this is what you would have wanted to have
I would have
seen
wanted
in the budget.
greater focus on that. You know, businesses in South Africa, Nedbank actually raised the point that administered prices are increasing too rapidly in South Africa, and actually that's one of the impediments of doing business in this country.
If you were Minister of Finance, what would you have done differently?
Maybe a little bit more tax stimulation, and done away with the increases in the dividends tax and the caps on retirement funding, just to stimulate savings a little bit more. That would have been my primary focus. All
right, out of 1 to 10, where do you rank this budget 2012, Mohammed?
I'd have to go very much middle of the road. I'd say 5, 6.
5, 6. Carl?
I tend to agree with that sort of rating, a 5 or a 6.
Annabel?
I go for a 6, maybe a 7, because I really like the the attempted consolidation of the budget. But I feel that not enough focus has been given, as I said, to some of the areas I mentioned, particularly administered prices and infrastructure spend. So we would have liked to see increased detail and some renewed focus. Perhaps there's room for that in the MTBPS. Some solid work being done before then by government to actually see in what areas can they actually reduce this acceleration of administered prices.
5, 6, and a 7, and that's where we leave the post-budget discussion. A big thank you to my guests, Mohammed Nalla from Nedbank Capital, Annabel Bishop, Chief Economist at Investec, and Mandy from PwC.